It gives me great pleasure to introduce our first speaker, Miss Alia Noor. She has a unique delivery style. Today, she will let us know how to keep in laws at an arm's length. I am really interested to know. Alia is an 18 years of experience in taxation and finance and regulatory affairs. She is a FTA registered tax agent and elected member of the FTA's business advisory group, giving her unique insight into regulatory and policy thinking and practical implementation. Her qualifications spans from UAE corporate tax, GCC VAT, TP and international tax, and Chartered Global Management Accountant of UK, Fellow Chartered Management Accountant of Pakistan, and she's also an MBA in finance. She's widely recognized as an award-winning tax consultant and leading speaker to simplify complex regulatory matters. Alia, the floor is yours.
Assalamu alaikum, and thank you, Sadia, for your kind introduction. And I'm thankful and appreciate the initiative taken by UAE ICAP chapter. And it's an honor to share the stage with Ajit Jan, who is a renowned TP expert in UAE, and to present among tax community and esteemed professionals is an honor. So let's begin the show. Okay. Okay, is it visible?
Yes, we can see.
Okay, now today what we are going to do is to teach you how to keep your in-laws at arm's length. And this is your transfer pricing survival guide. When I say in-laws, I mean in-laws. So let's have some housekeeping rules first. Today we are going to discuss how to keep your in-laws at a healthy distance. Just a minute. It's not working. Okay, the housekeeping rules is that today we are going to discuss how to keep your in-laws at healthy distance. Yes, I said in-laws and the ones from your better half side, and for balance in life and for fairness in tax, let me say this clearly. We will apply the same rule to your side of the family as well, because only then happiness extends to both sides of the family dinner. Now don't worry, this is not a family counseling session, this is a transfer pricing session. So first we need to know the game of the rules. So who counts as family and related party is the first question. Under UAE corporate tax, your family is not just your spouse or your kids. It's a huge extended universe because UAE corporate tax wants you to love all your 4 degree of relatives. Now, the first degree is your inner circle. So basically, these are the people who can walk into your house without knocking. They are your parents, your children, and yes, the parents and children of your spouse too. The second degree of kinship, now the circle gets wider. Your grandparents, grandchildren, siblings, and your spouse, grandparents, grandchildren, and siblings too. Now, this is the group that turns a quiet weekend into a full family gathering. The third degree, now it becomes a really family festivals which you meet at the weddings. Your great grandparents, great grandchildren, your uncles, your aunt, nieces, nephews, and of course the same from your spouse side. If you're from the Europe side, that it's easy uncle and aunt. But if you're from Pakistan side, it means your Thai and Thai, your Chacha and Chachi, your Mama Mami, Khala and Khalu, and the extended second level cousins. So at this stage, you start needing name tags at weddings. The fourth degree, welcome to the extended universe. Your great grandparents and great grandchildren, great uncles, great aunt, grandniece, grandnephews, and first cousin from your side and from your spouse side. Oops. This is where family WhatsApp groups have 300 plus members and nobody remembers who added whom. Don't get too excited. This is not end of the story. Sometimes it's not about blood or marriage. Under Article 35 of the UAE Corporate Tax Law, guardianship arrangements can also create related party relationships because legal authority over another person's financial affairs can amount to control. If a guardian makes decision effective another person's business or investment, those transactions must still meet the arm's length standard. Of course, it's wonderful to have a big family, that's a huge support system, but it's also a huge risk area if you are too generous in money, in terms of benefits, in terms of favors, or in terms of business terms. Because in text, being excessively loving financially or otherwise has a name. What is it called? It's called not being at arm's length. So as per UAE transfer pricing guide, the rules apply to transaction or arrangements between related party and connected person. And the related parties are not just companies, they include family relationships, ownership links, and controls. Family relationship, we have seen up to 4 kinship, the guardianship. Ownership means you have 50%, control means 50% control, significant influence, which we will see in coming slide. Now the question is, you don't know your family tree. So how will you know your family tree? Very easy. It's time that you should pay a visit to your granny. So you can get your family tree from there. Usually people and their old elders have shajara. That's called a shajara. That's a family tree. Because in UE transfer pricing, your family tree can become a tax risk map. So keep your distance when necessary, and peace is a boundary, not a punishment. That's the granny advice. That's how you keep your in-laws at arm's length distance. And this is called the related party and connected person segment. Now, how good fences? There's a saying that good fences make good neighbors. In text world, we say good boundaries make good related party transactions. And that's exactly what today's session is about. How transfer pricing helps you keep relationships strong and your tax position safe. You may call them relatives, but the tax law calls them related parties. Your family tree may look small at home, but under Article 35, it grows very, very fast. So now it comes the interesting story, the tax story. When related parties meet transfer pricing, what happens? Let's move on and see. Now, which relationship trigger transfer pricing? Under Article 35, these are the criteria. Family relationship, like 2 or more individual related up to 4 degree of kinship, which we have seen. Ownership, if 2 or more person or judicial person control 50% direct or indirect ownership. You have control over another company through voting rights, vote control, profit entitlement, or significant influence. In addition to that, a person and its permanent establishment is also considered as a related party. Partners in same unincorporated partnership are also considered a related party. Same goes for trust foundations and their founders, trustees, or beneficiaries. They are also considered as related parties. Now, when does the tax steps in? Once you have established the relationship, the key points to note is that the transactions between related party or connected person includes arrangement, not only formal contracts. This could be verbal arrangements as well. The cross-border and domestic transactions are both covered. Arm's length principle applies whenever control transaction exists, meaning prices must reflect independent market conditions. Even exempt entities or small business relief entities must follow the arm's length, but they may not be needing TP documentation if they do not meet the threshold. Now, how do you choose the right transfer pricing method? That's the second question. Now, how can we compare two independent companies when they are different in many ways? So, follow this rule. Transfer pricing isn't about a twin. It's about finding a cousin. A cousin, the goal is to identify key similarities, account for differences, and ensure pricing reflects the reality of value creation. How FT will check family pricing? When related party transact, tax law says, would independent companies agree to this price? The answer lies in applying the 5 transfer pricing methods to test arm's length. Now, how will you do that? Let's imagine you have a family restaurant and all family members share the profit or the dinner economies, we say it. I'll simplify it for you. Now, assume if the market already sets the menu price, we follow the market price. So it is called comparable uncontrolled price, CUP method. Now, if one family member cooks the meal for another, what will you do? You will reimburse the cooking cost plus small markup. This is called cost plus method. If one family member, assume, buys goods, food and resell it to customers, we look at the resale margin. Now, this is called under TP resale price method. If we cannot compare the exact meal price, what will we do? We compare how profitable similar restaurants are. This is called TNMM, net profit comparison. And the last one, the fifth one is, if several family members jointly run the restaurant, what will we do? We will split the total profit based on contribution. This method is called profit split method. But remember, no matter the method, the question is always the same. Would independent restaurants agree to the same pricing? Remember, this point will be carried forward in all slides. Now, coming to the practical aspect. Now, if you are in a situation where same or very similar product, services, price exist in the market, you can use the comparable control price method, which in our family logic, we share the menu price. And for example, the companies who are using this industry could be commodity tradings, intercompany loans with observable market interest rate. Now, when a related party buys goods and sells them without significant modification, right? In our family logic, when member buys food and sells it, we call it resale price method, RPM. And usually, distribution businesses are using this model in the industry. Now, the third category, when a related party manufactures goods or provides services to another group entity. In our family logic, we say someone cooks the meal and adds up markup. So we called it cost plus method. And in industry, contract manufacturing or intra-group services are using cost plus method. The fourth one, when direct price comparison is difficult, but profitability of similar companies can be compared, in family logic, we call it how profitable similar restaurants are. And this method is called transactional net margin method. This is TNMM. And the industry where these are applied are mostly, majority of the industry businesses are using this method. When you go to a benchmarking company, they will probably use TNMM. Routine distribution, service provider, all of them are using it. Even for salaries benchmarking also, they are using it. Now, the last one, when multiple related parties jointly contribute unique and valuable functions or intangibles. This is called, in our family logic, family members run the restaurant together and split profit. We call it profit split method. And mostly joint development or exploitation or IPs are using this method. Now, moving forward, related transfer pricing does not only apply to goods and services. It applies to payment to connected person as well under Article 36. So remember, family is emotional, but salary is legal. So you must love your family, but document their salary. So let's see, the story gets interesting when family salaries meet transfer pricing. Under UE Corporate Tax, Article 36, payment to connected person must be at arm's length and commercially justified to be deductible. Remember, commercially justified to be deductible. To review beyond benchmarking and looks at three things. What FTA do? They will check if you have a benchmarking, if you're paying a salary for family member or a connected person, the person qualification, experience, his contribution, the role, responsibility, and decision making power, and the size of the company, profitability, and industry context. That means one size does not fit all. If these things do not align, the FTA may question the deduction. And the final advice from Granny would be the Granny may approve the salary, but the FTA must approve the deduction. Now, where would you find the arm's length salary for connected person? The business typically rely on market compensation data, what has been seen in the market. These are useful for initial benchmarking references for SMEs cases. Like people are using Michael Page UE salary guide, his GCC salary guide, Robert Walters Mercer compensation, Cooper Fitch UE salary guides. These reports provide market salary rules by role, by industry, experience level in the UAE. But professional transfer pricing database, the paid ones, which are used by TP advisor and large groups, are S&P, Capital IQ, Orbis, Bloomberg, RoyaltyStat, Thomas Reuters, TP Catalyst. These databases provide financial data for comparable companies for benchmarking analysis. But from practical point of view, the approach depends on the company size, the risk level of transaction, budget for TP documentation. SMEs may rely on salary surveys, but large groups often require full TP database benchmarking. Now that was the theoretical side. Now let's move from theory to real story from the field. And this section is very interesting because I am a tax agent and I have a group of 100 plus tax agents, and they have contributed in this section the real life examples. So let's dive in and see what really is happening in the industry while at the first CT filing time. I will call the behind the scene. Expectation. Most businesses thought corporate tax was simple. Prepare accounts, calculate tax, file the return, blah, blah, and done. But the reality was changed. The CT return asks, how did you price transactions with your related parties? And suddenly, everyone looked like this. Hold on. They never told me any of this honestly stuff in school, in law school. Many businesses assume we'll just file the return. We'll worry about the transfer pricing later. Transfer pricing can wait. It's not urgent. We have already accounts. That should be enough. But the CT return asks questions many businesses were not ready for. The corporate tax return requires disclosure of related party transactions, connected person payments, total value of transactions, payments, transfer pricing, methods applied, and very importantly, this is not based on your balance sheet date. This is based on the value of related party transactions, payment, or connected person during the year. So related party transactions disclosure is required when total transaction exceeds 40 million. In addition, you are required to disclose individual transactions exceeding 4 million in this case. In connected person payment, disclosure are required when payment exceeds 500,000 during the year. Now, the lesson learned were that even small businesses can trigger TP reporting. If related party transaction cross the threshold, they will show on the balance sheet that we have not exceeded 40 million. But during the year, they have exceeded the 40 million transactions. Now here comes my handsome tax agent for my group. Stephen Ireland. Its TAN number is 200565111. Now, this agent, Stephen, has given us intel about the staff recharge mystery. Let's dive into the agent's briefing. Now, the situation was like that a UAE mainland company employed a team of technical staff and engineers. That amounts to 39 million. These staff were working on projects for a related free zone company. The mainland company recharged the staff cost to the free zone affiliates. At first glance, the arrangement looked like a simple internal recharge. But the financial statements triggered FTA audit. Look how the agent deals with it. The agent discovered why FTA triggered the audit. And during the audit, FTA sent a detailed email of detailed clarification asking, they asked for employment contracts of these 39 million, payment breakdowns, operational explanations. They also asked whether the company had any clients other than its affiliate. And then FTA asked a crucial operational question. Who actually controlled the staff? Now, what was the twist? The twist is the accounting question. The FTA noticed something unusual in the financial statements. The staff costs were recharged to the related free zone company, but the recharge was not recorded its revenue. We are talking about 39 million. This raised an important question. Was this cost reimbursement or a service transaction? Now, what was the agent inside? Somebody messaging me something. Let me see. Nothing for me. Okay. Okay, now what happened? What agent find out? He found out that the FTA review focused on three issues. Was the mainland company actually providing the services? Should the recharge be recognized as revenue, or did the arrangement require transfer pricing documentation? So, what the lessons were learned from the agent, which was shared with us, is that when staff costs are recharged to related parties, clearly document the services being provided. Ensure the accounting treatment reflects the economic reality and maintain a transfer pricing documentation to support the arrangement. So that was the case from Stephen Ireland. And now moving forward to our intelligent agent Reem Hussain Yusuf. And she has presented the case intel of the curious case of the shareholder loan. Her TAN number is 200183996. Now, Agent Reem briefed the situation. The company received a loan from its shareholder, which is a related party. Under UAE corporate tax rules, such rules must follow the arm's length principle. The advisor therefore started benchmarking the interest rate. But during the tax review by Agent Reem, another rule appeared. A second layer of rules. That is, during the corporate tax review, the interest deduction limitation rules were examined. The company had received shareholder loans totaling 8.6 million from multiple shareholders. It was identified that the loan was linked to an equity type of transaction, such as funding share capital or capital contribution. Now the whole scenario changes. The twist, there are two rules interacting at this point. Transfer pricing rules require related party loans to be priced at arm's length. The interest deduction limitation rule may deny the deduction depending on the nature of the financing. Now, what was Agent Reem's insight? The 8.6 million loan from multiple shareholders were reviewed under the interest deduction limitation rule. and was restricted for corporate tax purpose, as interest on related party loans is used for such equity type transactions which are disallowed for tax purpose. However, the loan transaction itself still remains subject to the arm's length principle. This means that even if the interest rate is benchmarked correctly, you spend a lot of money, the tax deduction may still be denied. Now, what was the lesson learned? These rules, the rules means interest deduction, are to prevent companies from replacing equity with shareholder loans to reduce taxable profit through interest deduction. Therefore, when analyzing shareholder financing, always review two frameworks together. Number one, transfer pricing, are they at arm's length principle? Number two, from corporate tax perspective, interest deduction limitation rules. Now that's me, you can recognize me. I am Alia Noor. I am a tax agent with TAN number 200570055. So my intel is the salary that passed the benchmark but failed the law. And this is very common practice. Now, what happened? A company paid remuneration to shareholder involved in management. Since this is a connected person transaction, the company performed a benchmarking study for managerial remuneration. They paid a lot of money. Now, the benchmarking indicated that the salary fell within the arm's length market range. At first glance, everything looked compliant. But what was the tax review question? During the corporate tax review, a different question emerged. Is arm's length market done through is arm's length benchmarking alone enough to allow the deduction? Because payments to connected person must also satisfy additional tax law condition. You must be facing this, that companies usually charge huge, significant amount of benefits along with the salary to shareholders, and those benefits are not business related. It could be their rentals, it could be their drivers, it could be their cook, their servants, anything, and it consists a significant amount of those salary. So there are two legal aspects. Article 36 requires payments to connected person to meet the arm's length test. However, this is not only requirement. Article 28 introduces a second condition. The expenses must be wholly and exclusively incurred for business purpose. This means passing the benchmark is only the first step. Now, what is the insight? Even if the remuneration falls within the market range, the company must still demonstrate the commercial justification for the payment and the actual role and contribution of the person, which we had seen in the previous slide, the role, the responsibilities, the qualification, the skills. The business benefit received by the company. And the lesson learned is that benchmarking explains how much was paid, but the tax law also asks why it was paid. And for connected person, both answers must be clear. Now diving into the fourth last case, that is Intel from Shiva Krishna Shankar, TAN number 200635333, and Shiva has shared the intel of the HR guide tribe, and this is a very interesting one. Thanks, Shiva. Okay, now the Shiva has briefing. The situation is that he observed that a construction contracting company with 650 million turnover prepared a TP study for managerial remuneration. The benchmarking used HR surveys only, which I have told you, Michael Page, Cooper Fisher, that one. The sources like Cooper Fisher and Hayes Compensation Guide. The company applied the CUP method based on this data. Remember, the CUP method is that in our restaurant business, when market price is already available, we use that market price. Now, what Shiva discovered was the gaps. The benchmarking relied entirely on HR compensation survey. However, the analysis did not include a FAR analysis of managerial roles. There was no industry or economic analysis of comparable companies. The CUP method was applied, but the required level of comparability was not demonstrated. In reality, the report relied only on salary survey data. So what's the problem? The twist is that weak defense. The company was a large construction contracting business with 650 million turnover. For a business of this size and complexity, HR surveys alone are not sufficient for transfer pricing benchmarking. Compensation surveys provide salary ranges, but they do not establish arm's length pricing. This created weak audit defensibility before the FTA. Now, agent intervened, and what he did is that he realigned from CUP method to TNMM method. TNM method is in our family logic when you compare the restaurant's profits. A detailed FR analysis for managerial roles were performed. Industry comparable companies were identified for benchmarking. Appropriate profit indicators were applied, including employee cost, total cost, operating profit margin. The lessons learned was that HR salary surveys do not constitute transfer pricing benchmarking and can be used as a supporting reference. A defensible TP study must include FAR analysis, appropriate TP method, reliable comparable. Why is that so? Because look at the revenue, at the turnover of the company was 650 million. They must have different operation, different it cannot be matched with a SME. Now, what we have learned from the real life case studies, let's decode them into the requirement of transfer pricing. That means what the tax authority actually wants to see in your cases, in your business, while you're submitting your tax returns. Number 1, arm's length price. Demonstrate that related party prices reflect market condition. Apply an appropriate transfer pricing method from the 5 we learned in earlier slides. Support the pricing with benchmarking analysis. Number 2, business rationale is very important. Explain why the related party transaction exists. Identify function, assets, and risks. This is called FAR. I forget to mention what is a FAR. Demonstrate the commercial substance of the arrangement. And number 3, documentation evidence is the most important. TP study, benchmarking analysis, you need to have intercompany agreements, local file and master file if it is applicable. I think for local file 200 threshold is required, and for master file 3.15 billion. If I'm correct, I don't recall exactly. But the important point is that the corporate tax return does not wait for an audit. It requires transfer pricing information at the time of filing. Okay, now we have seen the real case study, documentation requirement, but what happens if the things get awkward? The biggest transfer pricing red flags. What are the red flags? Let's have a few of them. Due to the time constraint, we cannot cover all of them. So first is the pricing in commercial logic risk. Now, you have high management connected person fee with weak support or they are not at arm's length. You have unusual profit margins, either too high or too low, with no commercial explanation because you are adjusting your financial in order to reduce your tax. High agent commission is not aligned with past trend of performance. One of our client, they came to us and they have increased 200% agent commission, foreign agent commission. We told them that it will not be accepted. by the FTA. They said, no worries, let it pass on. And we just took an undertaking and pass it on. Later on, they got a FTA audit and they asked for 8 years previous historical data. Although that time CT law was not in place, but they can ask it. Then they ask her what to do. I said, what can we do? Now everything has to do, the share will do everything. We will not do anything. It means share आगे आप क्या करें? आप जो करना है वो share ने करना है. The line will do the everything. We have told you everything. So just provide the data and they will be penalized. Now, you are applying family pricing instead of market pricing. You have persistent loss in the UAE entity while the group remains profitable. Intercompany loans, financing on non-market terms or without economic rationale. Your royalty IP charges with no clear link to revenue, creation or use. Now coming to substance and documentation risk. Here are few of them. Missing or outdated intercompany agreements. You file the return, you don't have any intercompany agreements. Then last time you are preparing intercompany agreements. No function analysis, who does what, who uses what, who bears risk. You haven't done that. That is the main thing for the benchmarking TP study. Function analysis. Benchmarking is not aligned with business reality. Generic copy paste TP studies with no link to actual operation. This is happening in the industry. You go to a benchmarking company and you pay a very cheap amount and they give you copy paste TP study and you are not capable to study it. You don't know what they have provided you. Documentation inconsistent with accounts of tax return numbers. Group services chart with no evidence of benefit received. Week of missing TP documentation despite material related party transactions. Now, when business logic ends, the family logic begins. And here it is the biggest transfer pricing risk. And one thing more I want to add that few benchmarking, you need to be able to see, to read what they have provided you. Sometimes you ask for connected person salary benchmark for the UAE and they're going to provide you the salary benchmark of the European region. When you ask the question, they say there is no salary benchmark for this region. So you have to be very vigilant what you are paying for and what you are receiving. Now comes a favorite subject, free zones reality. Now, why 0% does not always mean 0% risk? That's most of the clients asked us. Free zone status does not override transfer pricing 0% tax, does not mean 0% is scrutiny. You can enjoy the free zone benefits, but only at arm's length. Now, these are some of the risks which I am going to highlight in this slide. Non-arm's length pricing between free zone and mainland group entities, overcharging or undercharging to push profits into the free zone, service fee, royalty or commissions not aligned with functions performed, cost plus or TNM margin that don't match the actual risk profile, inconsistent TP methods for the same type of transaction across the group, year-end adjustment just to manage the free zone profit level. Regarding the substance documentation and compliance risk, free zone entity has people in name, not in reality, no decision making. Substance gone, disqualified. Function, assets and risk not aligned with the where profit sits. No benchmarking for free zone versus mainland transaction. Arm's length gone, disqualified. No intercompany agreements covering the free zone transaction. Weak or missing TP documentation despite material intercompany flows. CT return disclosures not matching with the TP story or result. Remember, TP story should be convinced with evidence. Now, there is a cost for every penalty. If a controlled transaction is not at arm's length, FTA will adjust your taxable income to the arm's length result. The adjustment is made directly in your tax return, increase profit or reduce losses. The burden of proof is on taxpayer to justify pricing with proper documentation. If a transaction lacks commercial rationale, the FTA may adjust or even disregard it. What does mean in monetary terms? You file late city return 500 per month for 12 months, then 1000 per month. You file incorrect return 500 if not corrected before deadline. Late payment of tax 14% per annum, calculate monthly. Voluntary disclosure of an error 1% per month on tax difference. FTA finds out the error first, you are late, 15% fixed penalty, 1% per month on the tax difference. Records and information failure, CD 209 of 2025. If you have no records, you cannot provide them, 20,000. You provide late information, 20,000. You provided false information, 60,000. Concealment and destruction of your evidence, your invoices, 100,000. Repeat within 12 months, double penalty. Wow. Then comes the APA. Is it a smart protection or it will overkill? That's the question. I call it the peace treaty within the in-laws, advanced pricing, APA. Now, in every family story, there comes a moment when the relationship with the in-laws become a little complicated. You want peace, they want transparency, and everyone wants to avoid argument. In tax term, this is where advanced pricing agreements APA comes in. Think of an APA as a formal peace treaty between the taxpayer and the tax authority, where both parties agree in advance on how related party transaction will be priced. What an APA is in simple words: a formal agreement with FTA on how your related party pricing will work, pre-approve the TP method and pricing logic for future years. That means 3 to 5 years. If you follow the APA, the FTA accepts your pricing approach. But when APA makes sense, you have high value related party transactions, you have complex structures, services, IP, financing, multi-step supply chains. You have long-term recurring transactions, high TP risk or likelihood of audit disputes. You have mixed tax rate setups, like you have one company's free zone, other company in mainland. Stable business models for the upcoming years when management wants certainty and predictability. But it has a cost. The cost is very high. For application fee is 30,000 non-refundable and renewal fee is 15,000 non-refundable, plus time, data, and preparation efforts. So when is it not feasible or not worth to have a APA? Because client asked me, we want to apply for APA. First thing was the cost. Now, second thing is that if you are doing low transaction, it doesn't apply. Simple root transaction with clear benchmarks, one of a short-term transaction, low TP risk where normal documentation is enough, unstable business models for frequent restructuring, weak data or documentation to support an APA case, urgent timelines. APA take times, 3 to 5 years, initial phase 9 months, then it is 2 years. Safe harbor transactions are excluded. The real trade-off is that you need to see what are the pros and what are the cons. The pros are certainty, fewer dispute, predictable tax outcome. And the cons are the time, the cost, effort, and deeper scrutiny. The final positioning is that APA is a risk management tool. It's not a shortcut. Do not think it's a magic solution. Use it for big, complex, high-risk transactions and skip it for small, simple ones. And the last section, that is your survival checklist. What to fix before your next filing. This is the article I wrote earlier on the LinkedIn that everybody looks like that. Apparently, they said, I'm fine, everything's open, it's fine, but behind the scene, they all look like this. It was a nightmare, the first tax filing. Now, what you need to do and what you need to fix before the next filing. Map your related parties and connected person, ownership control, family links. List all control transactions, services, goods, IP, financing commissions. Check free zone versus mainland flows and qualifying free zone person impact. Confirm the right TP method for each transaction. Test prices against market reality, no family pricing. Update your documentation, TP study, local master file, agreements where applicable. Align CT return disclosures with your TP files and numbers. Review red flags and risk areas before you file. Decide if an APA is needed only for big, complex, high cases. Replace hope with evidence. So, sum up, get the story, the numbers, and documents aligned before you file. The message to user: love your family, but document their transactions. Thank you very much. That's all from my side. Over to you, Sadia.
Thank you, Alia. Thank you so much. The your delivery style is so unique, and the presentations you prepared, I mean, must have taken a lot of effort from you. It
Yes,
was
I slept at 3 and then I woke up at 4:30 for for the sahur. So you can imagine how sleepy I am at this moment.
yeah, but I think it was for the audience, it was definitely a very, very engaging session.
Thank you, much
Thank you so much.
appreciated.
Thank you.